The people telling you the market is coming back don't lose money if they're wrong, but you do. And that's why today we're cutting through the spin and looking at the reality of where the GTA housing market is heading into 2026. Hi everyone, it's Diloshan, and welcome back to Real Estate Watch, your eyes and ears of the GTA housing market. Every December, the same headlines show up. Sales will surge next year, prices are set to rebound, and buyers are coming back. And every year, I have to remind people of one thing, that these forecasts usually come from organizations whose job is to sell on optimism. It's like walking into a car dealership and asking, should I upgrade my car today? You already know what they're going to say. So the Bank of Canada is expected to hold rates at 2.25%, as all economists agree. There's going to be no cutting, no hiking, just holding. And most economists don't even expect a move until late 2026 or 2027. Why? Because inflation is back inside target, the economy is still growing modestly, and the Bank of Canada already delivered 275 basis points of cuts. So this is not a signal for a housing boom. It's a signal for stability and patience. Now, let's look at the reality of the condo market, because this is where the math actually breaks down. Across the GTA, tens of thousands of new condo units are completing in 2026. And here's the problem. Most of them were bought anywhere between 2021 and 2023 at the peak of the market. And investor ownership is extremely high, anywhere between 80 to 90% in some buildings. And supply is hitting the market while vacancy rates rise. And many investors simply can't carry these units at today's rates. So that's why we're already seeing assignment sales, deep negative cash flow, and power of sale warnings. So this isn't emotion, it's numbers. Now, if we were to look at the freehold market, for example, let's say look at Ottawa, it's the most stable because it has government-driven employment, prices are flat, not spiking or collapsing, and it's balanced and stable. So nothing exciting there, but it's healthy. Now, if you look at another region, let's say Brampton, for example, Brampton has probably taken one of the deepest hits in Ontario. Why? Because number one, the illegal rooming housing model collapsed because student numbers dropped, temporary workers dried up, and the rental income simply vanished. Number two, a lot of the owners are over leveraged. So they have high HELOCs, most of them are high ratio mortgages, and cash flow based on rent that no longer exists. And number three, the power of sale pressure. Prices are down anywhere between 25 to 30% in some areas of Brampton, and lenders are selling fast, and every forced sale resets the comparable lower. And banks don't wait for rebounds. Another region that is under pressure is the Durham region. That's anywhere between Pickering to Oshawa, especially newer subdivisions north of Taunton. The issue here is that there's too much similar supply, there's a lot of high debt loads, and the return to office mandate is pulling demand back towards Toronto. And many homes were bought at the peak of the market in 2021. And prices are down anywhere between 20 to 25%, and the power of sale activity is starting to rise. So why do I think that the pressure will continue into 2026? Because power of sale is slow. It takes anywhere between 6 to 10 months from missed payments to hitting the MLS. So that means today's listings reflect problems from early 2025. And there's probably more in the pipeline working their way through the system. And each forced sale becomes the next low comparable, which pushes the next seller even lower. So this is a slow correction, not a sudden crash. And here's the data that nobody's really talking about. That Ontario has the highest unemployment rate in Canada. Toronto unemployment is the highest in 17 years. Household debt is at record levels, and return to office is shaping the demand. And there's more condo completions coming in 2026. Put all that together, and the conclusion is very simple. Anyone saying GTA prices are heading up by spring 2025 is probably not looking at the data. The fundamentals just don't support it. And one other risk that people are underestimating. Canada's trade relationship with the US is under serious strain. So US tariffs in 2025 have already hit exports, jobs, and growth, especially in Ontario. So if upcoming trade agreements don't land favorable, unemployment could rise, housing demand could weaken, and prices can stay under pressure longer. So this matters more than people actually realize. So what's my final take? Well, my job is not to sell on optimism. My job is to keep you ahead of the market. Yes, sales can increase because prices are lower, and there will always be buyers looking to take advantage of the market, especially some first-time home buyers. But that doesn't mean prices are going to go up. Stability doesn't equal recovery. So if this breakdown helped you, like, subscribe, and share. And comment below, what are you seeing in your city? Are prices holding, slipping, or are you seeing more power of sale listings showing up? Thanks for watching, and I'll see you in the next video.